India's electric vehicle revolution is absolutely on fire. And with that fire comes the temptation of the hot new IPO. Everyone wants to get in on the ground floor of the next big thing, right? But our job, as smart investors, is to cut through the hype and look at the cold, hard facts. So, is Victory EV the real deal, or is it just another story stock looking for your money? Let's find out.
Look, the EV market is booming, no doubt about it. But that excitement can be a smokescreen. It can hide some really fundamental weaknesses. So today, we're putting Victory EV under the microscope. We're going to see if their story actually holds up when you look at the numbers. Think of this as a reality check for a company that wants your investment capital right now.
So this is Victory Electric Vehicles. They're coming to the public markets with a big story about how they're going to capitalize on India's massive EV wave. But we're not just going to take their word for it. Oh no. We are going to tear down their IPO prospectus line by line and see what's really going on behind the curtain.
Okay, before we get into the nitty-gritty of the company, let's just zoom out for a second and set the stage. Because the big picture for electric vehicles in India, it is genuinely exciting. And honestly, it's the only reason a company like Victory EV can even think about an IPO in the first place.
I mean, you've basically got a perfect storm of positive factors here. The government is pushing hard with all kinds of incentives. People are more eco-conscious than ever before. And let's be real, with petrol prices going through the roof, the economic argument for an EV gets stronger literally every single day. This is that powerful tailwind that makes any company in this space look pretty attractive on the surface.
But here's where it gets really interesting. Forget the fancy high-end electric cars for a minute. The real action in the Indian EV market is with 2- and 3-wheelers. We're talking about a whopping 94% of the entire market, combined. This is the grassroots of the EV revolution, and it's exactly where Victory EV says it operates. All right, so we get it. The opportunity is massive. Now, let's finally zoom in on the company that wants to grab a piece of that pie. Let's hear Victory's story, based on what they're telling us in their own prospectus.
So what does Victory EV actually do? Well, this is their bread and butter. They design and they assemble electric 3-wheelers, the e-rickshaws you see everywhere for last-mile delivery and transport, and they also make low-speed electric scooters. They're not trying to be the next Tesla. Their focus is on that high-volume, utility part of the market.
And on paper, they lay out a pretty decent case. They'll tell you they've been in the game since 2018, they have a footprint across a dozen states, and they claim a special niche in the more powerful L5 category of e-rickshaws. And of course, they highlight their experienced management. This is the sales pitch. Now, let's see if the numbers back it up.
And this, right here, is where our job as serious investors really begins. We have to move past the story and get into the hard evidence, the financial statements. This is where we're going to find the real story.
So the very first thing we look at is revenue. In a market that's supposed to be exploding, you'd expect to see strong, steady growth. But what do we see here? Stagnation. For the last 3 years, revenues have been totally flat, and they even dipped in 2024. This is our first major bright red flag. In a booming market, why isn't Victory EV growing? What's going on? Okay, so now let's look at the profits. And this tells a very different, and to be honest, a very strange story. While their sales were going nowhere, their profit after tax suddenly exploded. I mean, look at that. From just under 79 lakhs in 2023 to nearly 490 lakhs in 2024. That is a jump of over 500%. So here is the crucial question. How on earth does a company's profits surge by over 500% when its sales are completely flat? This massive disconnect between the top line and the bottom line is a huge red flag. It screams that something isn't right. Either some very aggressive accounting or maybe some one-off gains, but definitely not sustainable, healthy growth. And this slide right here perfectly illustrates the problem. You've heard the saying, profit is an opinion, but cash is a fact. Well, while they were reporting those huge paper profits, the business was actually burning through cash. Look at these numbers. Negative cash flow from operations every single year. This means the core business of making and selling vehicles is not generating cash, it's eating it. This is a business that cannot survive on its own without more funding.
So the financial picture is already looking pretty worrying, but believe me, the story does not end there. So often, the biggest risks for us as investors are hidden away in the fine print. So let's turn the page to corporate governance and see what else we can find.
Now, before we get into the specifics, let's just quickly define this term because it's super important. Related party transactions are basically when a company does business with its own owners or directors. Now, these aren't always illegal, but they create a massive potential for conflicts of interest, where decisions might be made to benefit the insiders and not the minority shareholders, like you.
And guess what? Victory's prospectus is absolutely full of them.
The company pays rent for its factory and its office directly to its owners. It buys a key component, the battery cells, through another company owned by the same promoter group. There's this whole complex web of buying from and selling to other firms that are all linked to the promoters. This raises some really serious questions. Is the company getting a fair price? Or are these deals just structured to benefit the insider?
And just when you thought it couldn't get worse, there's this. The company has a history of financial distress. As recently as 2025, it was literally facing insolvency proceedings. A creditor had to take them to court because they couldn't pay their bills. Now, they did reach a settlement, but the fact that this company was on the brink of bankruptcy right before its IPO, that's a monumental red flag about its financial health.
Okay, so with that, troubling backstory, let's finally look at the IPO itself. Why are they raising money, and how much are they asking you to pay for a piece of this business?
The company says the money is for new machinery and a new building, but you have to notice this line: funding working capital requirements. This directly confirms that cash flow problem we just saw. It means a big chunk of your investment isn't going towards growth. It's going to be used just to plug the cash-burning holes in their day-to-day operations.
And this brings us to the ultimate question for any IPO investor. They've set the price at 41 rupees per share. But is the company actually worth that much? How can we even begin to tell?
Well, unfortunately, the prospectus gives us absolutely no help here. It offers zero peer valuation data. This is frankly a stunning omission. They're leaving investors completely in the dark, with no benchmark, no context, nothing to compare it to. They're essentially saying, here's our price. Just trust us. As an analyst, that's completely unacceptable.
Okay, we've looked under the hood. We have checked the numbers. We have read the fine print. It is time to put all the pieces together and come to a clear, final judgment on this IPO.
My verdict here is, well, it's pretty unambiguous. It doesn't matter what your risk appetite is. Whether you're a conservative, moderate, or a high-risk investor, you should avoid this IPO. The combination of weak fundamentals, questionable financials, governance concerns, and a history of near insolvency just makes the risk-reward profile deeply, deeply unattractive for everyone.
So, here's the bottom line. The exciting story of India's EV boom is simply not enough to make this a good investment. The stagnant revenues, the negative cash flows, those troubling related party deals, and a history of financial distress, they all paint a picture of a very high-risk company with serious fundamental weaknesses. Remember, in the search for the next big winner, it's just as important to know which ones to avoid.